On June 12th, we're going to get two big pieces of information that I want you to keep your eye on. Number one is the Federal Reserve Bank is going to make an announcement as to what they want to do with interest rates. And number two is we're going to get May's inflation data. Now, the reason why you want to pay attention to this is because the Federal Reserve Bank has been keeping their eye on two things. They've been keeping their eye on inflation and they've been keeping their eye on the jobs market. And they're going to decide what they want to do with interest rates. Now, at the same time, the inflation data that we're going to get for May is going to come on the same day that the Federal Reserve Bank is going to make their announcement, which means the Federal Reserve Bank is not going to be able to use the May inflation data to influence what they say about interest rates and what's coming next. But the reason why this matters right now is because there's a lot of pressure on the Federal Reserve Bank because now we have data showing that our economy is slowing because of the higher interest rates set by the Federal Reserve Bank. And well, nobody wants to see a slowing economy, especially during an election year. What we have heard until now is that the Federal Reserve Bank wants to keep interest rates higher for longer because inflation has been coming in hotter than expected for most of 2024 until last month where we heard that April's inflation numbers came in at expectations. Traders are currently pricing in a roughly 70% chance of a United States rate cut coming in September. That means we've been seeing these new record highs in the stock market in May because you have a lot of people on Wall Street hoping that this new inflation data is going to tell the Federal Reserve Bank that, hey, you can start cutting interest rates now, which would help stimulate the economy, which is why the stock market has been booming. And this is where we have two different camps of people and opinions of thought when it comes to interest rates. We have the doves, which are the people that are hoping and begging the Federal Reserve Bank to give us lower interest rates. These are the traders on Wall Street that want to see the stock market grow. These are the realtors. These are the mortgage bankers because lower interest rates will help people buy more homes and make them more commission. Then on this side, we have the hawks, the people that want higher interest rates for longer. This is just like Jamie Dimon, who came out and said that we need the higher interest rates to fight off the high inflation because the government is still spending money like crazy. That is inflationary, and we need to solve the inflation problem worse. And this is where the Federal Reserve Bank is getting more and more pressure on them to stop keeping interest rates high because it's starting to hurt the economy. Now, the Federal Reserve Bank has what's known as a dual mandate. That means they're supposed to make their decisions based off of two things. These things are number one, price stability, meaning inflation, and number two is maximum employment, which means the job market. What we have seen right now is that unemployment is still at some of the lowest rates we have ever seen. We have 3.9% reported unemployment numbers. Now, if you've been watching my channel, you know that, well, that 3.9% unemployment doesn't include people that are underemployed because we have about half of college grads that are graduating college, working high school level jobs, and then about 10 years out, almost half of college grads, 45% of college grads are working a high school level job 10 years after graduating college. So yeah, many people have jobs, but a lot of people are underemployed. That's the first part with the employment part. So then if we look at inflation, inflation is still higher than what the Federal Reserve Bank wants. Remember, the Federal Reserve Bank wants 2% inflation. We're still in that 3.5% range of inflation. So we still have quite a bit of a ways to go to get from 3.5% inflation to 2% inflation. And this is where the Federal Reserve Bank is going to have to make a decision as to what they want to do and what they want to indicate as to what direction they want to go for the rest of 2024. Because a lot of people, especially people on Wall Street, are hoping and betting that the Federal Reserve Bank, as we get closer to the election, is going to want to appease the market, that they're going to want to appease the economy, that they're not going to want to see any economic slowdown, and so that's going to entice them to cut interest rates. Now let's play that out. The Federal Reserve Bank cuts interest rates. What's that going to mean for the economy? If they start cutting interest rates, well, buying a car is going to be a little bit more accessible because now your interest rate is going to be cheaper. Buying a home might feel a little bit more accessible because now instead of paying 7% on your mortgage, you can get a mortgage for 5%. And businesses are going to have, well, a lot easier time to refinance because we have this wall of corporate debt. Remember, corporate debt and commercial real estate debt is not a 30-year fixed rate mortgage. And back in 2020 and 2021, every commercial landlord and every business sitting on debt was refinancing and pulling cash out. That means corporations and landlords were taking on huge loads of debt because you could borrow money at the lowest rates ever, at 2 or 3%. So every corporation and every landlord that's sitting on debt refinanced or took on debt in 2020, 2021 at the lowest rates ever, but that debt readjusts every 3, 5, 7 years, which means starting in 2024, we're starting to see that first batch of corporations and commercial landlords starting to see that debt readjust. So now they're going from 3% to 7 or 8%. which means the cost on that debt is going up. And if these corporations and commercial landlords are not making enough money to service their debts, then either they're going to have to pass the cost on to the consumers or the tenants, or you could see more defaults. So that's why you're seeing a lot of corporations and a lot of commercial landlords that are pushing for the lower interest rates because that can help keep them in business. But while this can stimulate the economy, it can stimulate spending, and it can stimulate growth, it comes at a price because remember, what is inflation? When we measure inflation, the Federal Reserve Bank is measuring the price growth of things. And what we've seen over the last 4 years is that the prices of things have grown very quickly. And so now, what happens if we start cutting interest rates? People are going to buy homes again, faster. People are going to buy cars again, faster. People are going to spend more money again, faster. Which, yeah, is good on the economy, right? Because now realtors are making money, mortgage bankers are making money, businesses are making money. It's great because now money is being spent. But if you have now 20 offers on every home that's listed for sale, what is that going to do to home prices? Home prices are going to go back up. What's going to happen to car prices if everybody wants to buy a new car? Everybody wants to buy the next G-Wagon. Car prices are going to go back up. Remember what happened a few years ago? People were paying $10,000, $20,000 over MSRP to buy a car. It was a very strange economy. So the Federal Reserve Bank risks creating more inflation by cutting interest rates. That's another thing that they have to pay attention to. That if they preeminently start cutting interest rates, yeah, it could help stimulate the economy even more, but that can make the inflation problem worse before they've even solved the inflation problem. And then we have what I have always liked to call the X factor, which is what the government is doing. Now, this one is an interesting part, and we've been talking about this in market briefs. But the United States government is contributing to inflation. And I'm not saying this from a political perspective. I'm saying this purely from a financial perspective, because if we look at inflation as the creation of new currency, that's really what inflation is. It's inflating the monetary supply. When the government spends money they don't have, they run a national deficit. This has been happening for more than 2 decades now, but it really accelerated during the pandemic. So now, if the government makes $4 trillion of tax dollars, but then they spend $6 trillion, that's a $2 trillion deficit that they have to get this money from somewhere. And a big chunk of this deficit is coming from the Federal Reserve Bank, because now the Federal Reserve Bank has to print money and lend it to the United States government. And this is where what Jamie Dimon has been talking about is government spending hasn't been slowing down. In fact, they're projecting spending increases. So now, we still have this inflation problem. We have this slowing economy, and then at the same time, the Federal Reserve Bank is working to fight inflation while the government is still spending money. Now, the goal of the government to spend money is to stimulate the economy. Think of it like cutting interest rates. When you cut interest rates, it helps to stimulate the economy. When the government spends money, it stimulates the economy. Why? Because when the government spends money, they're hiring contractors. They're hiring construction companies. They're paying military companies. They're paying firefighters. They're paying police people. They're paying people in the economic system. So now you get a salary, you get a job, you're funded because the government is paying your salary, which is good because that means people have money. But it's bad because the government doesn't have the money to pay for these things. This is how government spending becomes inflationary. It's because they're not spending just the money that they have, they're spending money they don't have. And in order for the government to spend money they don't have, this money has to be printed through the help of the central bank, which is the Federal Reserve Bank, which means more money has to be created, money is given to the United States, or rather it's lent to the United States. The government then spends this money, there's more money in the circulation of our economy, people have money to spend, so you feel good, but then the value of each individual dollar goes down. Because remember, our paper dollars are not backed by physical gold or any metal. This is backed by a promise that the United States government says that your dollars have value. And so now if you just keep printing more of this paper money, the value of each individual dollar goes down. And this is where you have the balance. What do? Do you cut interest rates, stimulate the economy, keep interest rates high, fight inflation? Inflation disproportionately hurts the people that are not financially educated. It disproportionately hurts the middle class and the financially poor because, well, if you're not financially educated, inflation means you got to spend more money on your groceries, on your rent, in your car, and your salary is not growing fast enough. But for the financially educated and the wealthy, you own assets. Inflation is making the value of your stocks, of your real estate portfolio, of your business portfolio a whole lot more valuable. And this is where you got to understand the pros and cons. Nobody wants to go through an economic hardship. Nobody wants to go through economic pain. But inflation is a consequence of just constantly stimulating the economy with money that we don't have. Now, for those of you that like to stay up to date on what's happening, when it's happening, we have a free newsletter at Briefs Media called Market Briefs that breaks down what's happening in the financial news, in the economy, in the housing market, in the stock market, in crypto, and the global economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link for you down in the description below. So as we're getting ready to hear what the Federal Reserve Bank is going to say and to see what is happening with inflation, the key isn't to see what the Federal Reserve Bank is going to do in June, because they're probably not going to cut interest rates in this next meeting in June. But the key is, what are they planning on doing towards the end or later in 2024? Are they more likely to keep interest rates high or to start cutting interest rates? And the key thing that you want to pay attention to is how often they're talking about the economic slowdown. Are they worried about the economy? Because if they're worried about the economy, that could mean potential interest rate cuts sooner than expected. If they're still honed in on inflation, that could mean that they're going to keep interest rates higher for longer. And the way that they phrase that can impact the short-term moves with things like the stock market. But I don't want you to be caught up in what's happening with emotions. I don't need you to worry about the day-to-day stuff. Pay attention to the trends. Pay attention to what they're saying. That way you can be a more educated investor. And now I'd love to hear from you. What do you think, number one, the Federal Reserve Bank is going to do through 2024? And number two, what do you think the Federal Reserve Bank should do? I'd love to hear your thoughts, and yes, I do read your comments. President Biden says that he wants to raise taxes on investors, corporations, and households making over $400,000 a year. What I want to do today is go a bit deeper into my thoughts on this proposal and help you really understand the implications of higher taxes on investors, corporations, and individuals making over $400,000 a year.